In this presentation, we will take a look at part one of an example problem related to a private college, the second private college example problem we have looked at. We're going to be going through transactions, financial transactions related to the private college. We got the information on the left. We're going to be entering that information into a journal entry, which we have down below, then posting that journal entry to our trial balance worksheet on the right. The trial balance worksheet being in order in the assets in green, liabilities in orange. We have what would be the equity section in a for-profit type of organization, here being the net assets section, broken out between the with and without restrictions, one of the key components that will be different from the private college to other types of for-profit organizations. Below that, we have what would be the income statement for for-profit type of organizations, including those temporary accounts, revenue and expense type of accounts, those that would be closed out to, say, the equity section in a for-profit organization, closed out here to the net assets section. And so we have on the left, gross tuition and fees account for the $5,750,000. Of those, we have tuition waivers and scholarships. So here's the total of the fees that we have, the $5,750. That's going to be kind of like the revenue that we will have. Of that amount, we have the tuition and waivers of $427,000. Of the tuition waivers, the amount for teaching assistantship and therefore instruction expense is going to be the $292,000. So part of these waivers, in other words, is because people were working, students working for the institution, helping out the teachers, and therefore the expense related to that help is going to go to the instruction expense. So we're going to record this in one transaction. This would be similar to us basically recording the transactions for the entire time period as one type of transaction. So here we go. We're going to say that the tuition and fees receivable will be increasing. It'll be increasing by the total amount of the tuition and fees minus the waivers. So if we pull out the trusty calculator, we're going to be taking the 5750000 minus the 427,000, and that's going to mean that the receivable, the amount that we actually expect to collect on, is going to be the $5,323,000. Then the credit side, so that's going to be this number. The credit side is going to be recorded in the tuition and fees without restrictions. That's going to be our income account. That's our major income account here. That's going to be going up with a credit direction. That's going to be this $5,750,000. The difference between those two is going to be the amount of the tuition and fees that we have that we're not going to be collecting on, and that's going to be due to the tuition and fee waivers and scholarships. So the waivers and scholarships are total the 427, and the amount that's for people working for the college helping out the teachers is the 292.5. Therefore, the 292.5 we're going to be recording in instruction expense. So that's going to be a debit to the instruction expense because that's basically a barter type of situation. We've got the revenue. We're not going to collect cash on it. Instead, they worked for it in that type of fashion. Therefore, we're going to debit the expense that was done. That's going to be to the instruction expense. The other portion, which is going to be the 427 minus the 292.5, which is the 134,500, is going to go to the tuition and fees discount and allowances. So you'll note that this is going to be our revenue account. Of that, we're not going to be collecting on some of it, this due to the scholarships, and therefore we're going to have to reduce it. Instead of reducing the income account directly, debiting the basically income account, making it go down, we're going to create another account which acts kind of like an expense, goes up in the debit direction, but is really kind of like a contra revenue account, bringing down the revenue. Let's post this thing out and see and take a look at it in more detail. We're going to say that we have the tuition and fees receivable. That, once again, is going to be the full amount minus the amount of waivers and scholarships that we expect to receive in the future. We have the tuition and fees receivable going up in the debit direction to the ending balance here. Then of those receivables, let's go jump down here to the tuition fees without donor restrictions. That's our income account for the full amount. The income account for the full amount down here, increasing by that $5,750,000. Then the difference between those two, the $427,000, Of that difference, part of it is the tuition expense, barter situation. Therefore, we're going to record the expense of the people, in essence, earning their tuition through labor, through work, increasing the debit balance on the expense side here. The last part wasn't earned. What it is basically a scholarship, so we're going to have to reverse it out. Instead of reversing it out of the income account, instead of reducing the income account, because we're not going to get paid for this either in labor or in terms of money, we're going to create another account, which is kind of like a contra revenue account, but acts like an expense account. It goes up in the debit direction, but really it's bringing down the equity or the income account here. So that'll put us back in balance. We can see with the green zeros, debits equaling the credits. This is the effect on the what would be similar to net income, basically the bottom line. It has a credit, not a loss. The credits are winning by the 5,323,000. Next, we have the tuition refunds. So tuition refunds, there's going to be a refund of the tuition. We're going to say it's a tuition refund on account, meaning we had a receivable here that was owed to us, and then we refunded it. So basically, we're simply going to reverse what we would have done when we recorded the tuition. When we recorded the tuition, we debited the tuition receivable, and we credited the tuition fees without donor restrictions. If we're going to have the refund, we're going to reverse that transaction. Therefore, we're going to be reducing the tuition receivable. It has a debit balance. We're going to do the opposite thing to it, which will be a credit. So we're going to credit the tuition receivable. We're going to debit then the income kind of account, the tuition and fees without donor restrictions. And so we're going to debit the income type of account. That's a little bit unusual, something you might not see in a for-profit types of organizations. This would be similar to a return. If something was returned in terms of a for-profit organization, inventory was given back, in which case we do reverse the entry in essence, but instead of debiting the sales account, which we don't typically do, we don't typically reduce the revenue account, we would typically create another kind of contra sales account, one that acts like an expense, but it's really a contra sales account, such as some type of allowance account. Here, we're actually reducing the income account directly. So that might be a little bit different, so you want to be aware of that. So we have the tuition fees without donor restrictions here. We have the credit balance in the tuition and fees. We're going to debit it, bringing it down. Then we have the tuition and fees receivable. It has a debit balance. We're going to credit it, decreasing the receivable. Next transaction, we have the unrestricted private gifts. We have the cash restricted for grants and securities for endowments. So these are examples of other types of revenue type of activity. Again, we're going to group them all together in one type of transaction. That'll give us some comparing and contrasting of these different types of things that can happen that could be increasing the revenue amounts, comparing and contrasting items with and without restrictions. So if we have the unrestricted private gifts, we're going to assume that those private gifts are with money, and therefore we're going to be debiting the cash. So cash is going to be increasing. It's not going to be the only thing included in cash, so you can kind of think of the number in cash being last thing we do. We'll do basically the plug formula to figure out what the cash should be. Then the credit is going to go to some kind of like a revenue account because it's a contribution. Now these don't have the restrictions, so it's going to go into the revenue account without donor restrictions. So we're going to go into the revenue account without donor restrictions. Then we're going to have the cash restricted for grants. So now we're going to say that we got cash, but this time it was a grant and it was restricted. So the cash is now restricted. Cash would then be going up again as well. However, and we would have an increase to an income kind of account, contributions. However, those contributions will now be restricted for grants. So the credit's going to go into the contributions, which will then be restricted for the grants. Then we have the securities for endowments. Securities for endowments, we're going to say that those securities then are going to be going to the institution. We're going to be increasing then the investments. So we're increasing the investments then increasing. The credits going to the contributions with donor restrictions again. So it's a revenue type of account, this time being the restriction of the endowment. Okay, then so if we post this out, we're going to say that and then of course the cash would be the difference. So if we're going to take the credits minus the debits, the cash would be the debit here. It would also be equal to this amount plus this amount. Those are going to be the two cash amounts. The other one, of course, we got paid with the investments. So posting this out, then we're going to say that the cash is going to be increasing. Cash is up top, has a debit balance in it. We're going to be increasing it in the debit direction to the ending balance. Then we have the investments that are going to be increasing. So we got an investment, something other than cash. That's going to be increasing in the investments, has a debit in it. We will then be increasing in the debit direction to the ending balance. And then we have the three contribution type of accounts broken out by the restriction and type of restriction. So we have the contributions without donor restrictions. That's going to be our favorite type of account. So we've got the contributions without donor restrictions going up in the credit direction, increasing what would be similar to the net income type of number. Then we have the contributions with restrictions with regards to grants. So the increase in the contributions with restrictions with regards to grants, and contributions with donor restrictions with regards to an endowment. So that's going to be increasing the amount with the endowment. Next transaction, we've got pledges of $1,892,000. The amount of the pledges for construction campaign. In other words, we have pledges happening here. These are promises to pay. They haven't yet happened yet. Of those pledges, some restrictions has been put on them for the 613,400 for some type of construction campaign. So we have amount of those pledges, those promises to pay that are restricted. And then the amount of pledges for endowments, the 540,200, it will of course be restricted as well. So recording this transaction, we're going to say we have pledges. These are going to be promises to give us money. So we've kind of done our job to the extent that we got a promise to give us money. So that's great. We're going to debit then the pledges receivable. We want to do that even though we might say, hey, a lot of those endowments might not come through. A promise to pay somebody from somebody that's going and asking for money and not receiving anything in return might not always be the type of thing that you're actually going to collect on all of it. And therefore, you might say, well, it seems premature to enter the pledges receivable and possibly revenue related to pledges. However, we do want to put the pledges in place because we have to track the receivable so we can follow up on it. So we need to be debiting the pledges receivable. Then when we credit, then we're going to credit the amount that's going to be restricted for sure. Obviously, the amount of pledges for construction campaign. If they said, hey, I'm going to pledge you some money, but when you get it, I want it to specifically go to this construction campaign. Therefore, we're going to have to credit it directly to a restricted amount. So we have the contributions, revenue type of account, but it's going to be restricted with regards to the capital campaign, some type of construction campaign. Then the amount that's going to be restricted with regards to endowments, if they say, hey, I'm going to give you this money, but I want it restricted with a specific regards to endowment, then we're going to say, okay, we're going to have the contributions, increasing the contributions, credit it with a specific restriction with the endowment. Then if the rest of it, the difference between the two, which is going to be the $1,892,000 minus these two items, which ends up with the $738,400, that amount still restricted. Notice it's not unrestricted here. It's still restricted due to time. And that's kind of like one of the checks that we put in place for the fact that, hey, we have a promise. We haven't yet earned it in the sense we haven't done anything except for go out and get the promise. But there's no real exchange that's happened. So to record revenue could be seeming kind of premature as opposed to in a for-profit type of organization. When you actually do the work, that's when you record the revenue. Here, there's no real work to record other than getting the pledge. So possibly you could think of as the fact that we're going to put it into a restriction due to the time could be kind of a bit of a check on that activity. So we're going to put it into revenue. We'll still be restricted with regards to time. Posting this out then is going to look something like this. We're going to say that the pledges receivable will be increasing. Pledges receivable is going to be a debit balance account. It's going to go up in the debit direction. Then we're going to have the three contributions accounts, again, going up with regards to the related restrictions that they have. The first one, contributions with donor restrictions for the capital campaign, increasing this item in the credit direction, increasing in a revenue type direction. Contributions for the restriction of the endowment, increasing this account. Once again, a revenue type of account, increasing what would be similar to net income. And then with the timing restriction, increasing here. There we have it. That, of course, brings us back in balance, indicated by the green zeros, and the net income is calculated revenue over expenses. Credits minus the debits would be included in these numbers. Then we have next transaction, provided goods and services that generated cash. So now we're going to say, hey, there's goods and services from the private college that we're providing that generate cash. This would be more of a business type of transaction. This would be kind of outside the normal type of transactions we would think of for the private college, because you would think that most of the income would be from the tuition and fees. So this is going to be over and above that. So what do we do with those types of sales then? We're going to say, all right, we've got cash. Cash is going to be increasing by the 110,770. And then we're going to put the credit in the income type of account in auxiliary enterprises without donor restrictions. And that's basically going to be kind of like other income. It's a business type of income, but it's not our primary business activity. Therefore, we're going to put it in this account, naming that it's not our primary activity and kind of tracking that separate to the tracking of the performance of the institution, the school itself. So if we post this out, then we're going to say cash is going to go up top. Cash is going to be increasing in the debit direction. The other side going to the auxiliary enterprises without donor restrictions. That's going to be increasing in the credit direction. Again, another kind of income type of account, increasing the credits in the temporary accounts, back in balance down below, and the debits minus the credits, or the revenue minus the expenses, results in what would be similar to a net income of the 11,104,200. Now we're going to have the collections on the tuition receivables. So collections on tuitions receivable throughout the time period. We're going to record this all as kind of one group journal entry. These are all the collections on the receivable. Would be similar as to a for-profit type of organization. Obviously, we're collecting, therefore cash increasing. So we have the debit to cash. The credit then going to the tuition fees receivable. Tuition fees receivable, the receivable on the books already being up here on the books as an asset. We already recorded the revenue when we put that on the books. We are now reducing that asset as we are collecting another asset, cash going up, that asset, the other asset receivable going down. Posting this out then, cash here, cash is going to be increasing the cash account in the debit direction. The other side then going to the tuition and fees receivable. Tuition and fees receivable having a debit balance, we will be crediting it, making it go back down. No effect on the income statement type numbers. No effect on what would be similar to the net income type number. Next transaction, unrestricted cash invested. So now we're going to take some of our money that we have in cash that's not restricted, and we will then invest it. So that means that it's going to be similar as to a for-profit type of organization, same kind of thing. Cash up here, we have this amount in cash. We're going to take some of it out, put it into an investment. The investment then increasing. Investment is a debit balance account. We will make it go up by doing the same thing to it, another debit. We will then be decreasing the cash. Cash is a debit balance account. We will decrease it by crediting it. So here's that transaction. We're going to post it out, or the investment first. Investments have a debit balance. We're going to increase it in the debit direction, increasing that balance. Next, we have the cash. Cash has a debit balance. We will be crediting it, decreasing the cash balance. Next transaction, we have the purchase of computer equipment. So now we're going to purchase computer equipment. Again, similar to a for-profit type of organization, same kind of activity. We're going to purchase it with cash. Therefore, the cash is going to be a credit. So we'll credit the cash to make it go down. The debit is going to go to equipment. Notice it's not going to equipment expense. It's going to go to equipment, the asset. We're going to capitalize the equipment because we expect it to be something that will be living for a long-term time period, to be in accordance with the matching principle or expense recognition principle. We put it on the books as an asset. Then we will depreciate it, allocating the cost to the time period in which it was consumed with the use of depreciation expense. So we're going to debit then equipment, which is a type of property, plant, and equipment. Equipment up top has a debit balance. It's going to go up in the debit direction. Here's the ending balance. Then we have the cash. Cash has a debit balance. We're going to be crediting it, making it go down. Here's the ending balance. No effect on what would be similar to the net income, the income statement type of accounts, income and expenses. And of course, we're back in balance. When will there be an effect in the income statement accounts or on what would be like in net income? When we depreciate the equipment and calculate the depreciation, record in depreciation expense.